Martin Smith from eNCA Capital joins me now to break down those numbers. Martin, as always, thank you very much for your time this evening. Let's start with those overall market movements. I mean, what we saw in the beginning of the week in terms of that major sell-off to what we saw on Tuesday and this afternoon, quite a difference. Talk us through the local bourses movements, but also I need you to weigh in on the Rand.
Yeah, there's a lot to unpack, I think, globally, but let me start with the kind of local side of things. So you've had quite a significant sell-off on Monday in the JSE. We bounced back quite nicely since then. I think a little bit of bargain hunting is come into play. Obviously, commodities also do what they need to do, or commodity stocks, should I say. But I think there's still a bit of unease. We have held up on the local side of things a lot better than what we have kind of offshore. Offshore markets have been feeling very much, or have been feeling the effects of risk of sentiments to a massive degree. Because again, there's any one of a few things to pick. I mean, you've got Chinese growth, you've got global growth coming under scrutiny with the IMF cutting their figures down. You've got the war, you've got US interest rates and inflation. You've got a little bit of a disappointing number out of US GDP earlier today. So there's just a lot of things. We are very much in the eye of the storm. And to your point on the Rand moving the way it has, is the Rand is essentially starting to behave like it has always, which is a kind of risky asset. I think I spoke on the show maybe a couple of weeks ago, and I said it's so interesting because you're seeing global markets sell off, but the Rand getting stronger, which doesn't often happen. But now, as global sentiment hits kind of a new low, and I think we're pretty much in line for our worst month on the US markets since March 2020 when we had COVID, I think the Rand is starting to factor in all of those things, as well as looking at kind of local things as well, like the floods, like Eskom and the like. So I think it's just risk off kind of across the board.
No, absolutely. Let's get into some company news now, Martin. We had Clicks results out today. So profits, they managed to get up by about 26%, but the chief executive warning that the rest of the year is going to be constrained because obviously consumers are facing increasing financial pressures.
Yeah, absolutely. And that's something that all the retailers are going to have to take into consideration. Inflation, higher interest rates, definitely going to affect the consumer. But Clicks is one that's been managed very well. Great management team, have just consistently delivered growth. Again, here diluted headline earnings per share, about 10% up, pretty much within what they guided to with their updates a couple of weeks ago. So nothing that really surprised me. The thing with Clicks is it's always, yes, they deliver consistently, but it's always been a very expensive share. The foreigners also love it, but again, you're paying for that growth. So do you buy it now? I don't know. I'm happy to wait on the sidelines. I think it's a lot kind of more expensive than it's been in the last 3 years. So something always to consider with the company.
I've run out of time, so I'm going to squeeze these two in at the same time, Martin. Dis-Chem's trading update as well as Pepkor. What did you make of what they are communicating to shareholders?
Dis-Chem, also very, very strong set of numbers, probably a little stronger looking than it actually is because you've got the Baby City acquisition in there. So take that out, it's roughly probably a little bit better than Clicks. Same story with Clicks, good growth, but quite expensive now, trading at the same multiple as Clicks is. But there's probably more runway for growth with Dis-Chem, given that they've got a smaller set of stores and they can roll that out. So there's potential there. Pepkor, very good set of numbers, also better than initially kind of appeared, also worse than initially appeared because you've got provisions around sign-off, but still a very good number and probably about 7% better than the kind of consensus was looking for. I think Pep could be a nice company to buy, good value, and yeah, I think can be added to portfolios.
No, and I think with that sentiment, Martin, it's well positioned in the current economic climate, given that it caters to the lower LSMs and those who can afford to be buying there. So it's well positioned at the moment. But Martin, absolutely, as always, thank you very much for joining us this afternoon.